When cryptocurrency CEOs get summoned to private meetings with regulators, something significant is about to shift. This wasn't a public conference. This wasn't a standard panel discussion. Regulators just brought the most influential figures in digital assets together behind closed doors. And that timing, it's anything but coincidental. The last time something comparable occurred, the entire market infrastructure transformed completely. Today, I'm breaking down what they're constructing and why this carries more weight than most observers currently understand. Before we dive deeper into this analysis, let me address something important for those genuinely committed to building substantial wealth. This is precisely why I developed the 100X Club. Inside, you receive exclusive weekly stock alerts highlighting high potential opportunities, the Millionaire Blueprint demonstrating how successful investors think and position themselves, plus a comprehensive framework engineered to help you intelligently expand your wealth over time. You'll find everything in the pinned comment. 3 critical takeaways you need to understand. Let's examine the essential points because there are 3, and each one carries significant weight. Key takeaway. 1. Market manipulation in plain sight. XRP dropped below $2 following a 6-day correction despite constructive signals from ETF inflows and increasing on-chain activity. So what should we call that? Manipulation, plain and simple. Market makers are suppressing the price deliberately. Why? Because they want you out. They want your XRP. They want it for their clients, for institutional accounts, for over-the-counter accumulation. This is precisely how the game operates. Shake out retail, accumulate for institutions. This is exactly what Ondo is executing out there, already collaborating with BlackRock. And let me pose a question to you. Do you genuinely believe BlackRock entered this space because they were uncertain about where the future was heading? Do you honestly think they stepped in without understanding who Ondo was working with behind the scenes? Come on now. Do you also consider it mere coincidence that Ondo is hosting their major summit at the beginning of February at the precise moment the New York Stock Exchange announces they're going all in on tokenization? Because I certainly don't. Now listen carefully. If anyone tells you they know exactly which blockchain this will all operate on, they're being dishonest. Nobody knows yet. And the reason nobody knows is straightforward. It hasn't been announced. But here's what has happened. Ripple just announced they're partnering with TJM, a regulated broker serving institutional investors, to make trading clearer, faster, and more efficient. When I first encountered that announcement, I had the same reaction many of you probably did. What exactly does that even mean? I'm right there with you. I didn't know either. I wasn't even familiar with who TJM was. So what do? We investigate. Understanding the TJM partnership. After research, here's what emerged. TJM is a regulated institutional broker. That alone should capture your attention, but it extends deeper. They're concentrated on improving the velocity and efficiency of trading and settlement processes using blockchain technology. Now, let me ask you something. Does that sound like infrastructure the New York Stock Exchange might need, utilize, or already be preparing to implement? Yeah, exactly. And here's where it genuinely starts to connect, because this partnership isn't merely about speed, it ties directly into real-world asset tokenization. Read that again carefully, real-world asset tokenization. The reporting states very clearly that this is part of a broader movement where traditional financial assets, stocks, bonds, commodities, real estate, are represented as digital tokens on a blockchain. What does that accomplish? It makes them easier to transfer. It allows them to be divided into fractional portions. And most critically, it enables them to trade 24/7, not just during restricted market hours. Now tell me, doesn't that sound perfectly synchronized with the New York Stock Exchange's announcement? Because to me, that alignment is unmistakable. The CFTC's Digital Asset Pilot Program. Now let's transition to the next piece of information. And many of you probably overlooked this, but I didn't. Back in February of last year, the CFTC, yes, the Commodity Futures Trading Commission, published this directly on their official website. They announced they would be launching a digital asset markets pilot program focused on tokenized, non-cash collateral, including stablecoins. And who were the participants? Circle, Coinbase, MoonPay, Crypto.com, Ripple. Let that information settle in. And who was orchestrating this initiative? Chairwoman Caroline Pham. Now, this is where it becomes fascinating. This is the same Caroline who has been photographed with Brad Garlinghouse, the same Caroline who has visited Ripple's offices, and the same Caroline who is now collaborating with MoonPay. So, how does this connect to the New York Stock Exchange and tokenization? Here's the connection. The CFTC program is concentrated on tokenized collateral infrastructure. So, ask yourself this: if the NYSE is going to tokenize stocks, what do they require to make that functional? They need tokenized collateral. They need a system that enables those trades to settle efficiently, and that's precisely what the CFTC is constructing. 4 critical points connecting everything. Let me break this down into 4 essential points, and I want you to pay close attention. Number 1, collateral systems. If you're trading tokenized stocks on the NYSE, you need tokenized collateral supporting them. Period. The CFTC pilot is establishing the groundwork for that exact framework. Number 2, a regulatory sandbox. Now, who's operating inside that sandbox? Coinbase, Crypto.com, MoonPay, Ripple. Does that roster look familiar yet? Number 3, interoperability. Oh yes, that term again. Because having major participants like Circle, Coinbase, and Ripple involved means they're developing standards that function across platforms, regardless of which blockchain the New York Stock Exchange ultimately selects. Are you beginning to see the picture forming? Number 4, institutional confidence. The CFTC's direct involvement transmits a very clear message. This isn't crypto speculation anymore. This is legitimate market infrastructure with government oversight. That's what institutions require before they deploy trillions of dollars. Now zoom out and examine the larger picture. The CFTC is constructing the on-ramps, off-ramps, and safety mechanisms for institutional tokenization. Brad Garlinghouse's vision from Davos. Then we have this from Brad Garlinghouse. And here's an interesting detail before I share this clip. You see that cup Brad is holding? That CNBC coffee cup? You realize that's not hot coffee, right? That's a microphone. If you've ever watched shows where people walk around with coffee cups during interviews, same concept. The cup conceals the mic. Let's hear what Brad said. The theme of rebuilding trust is paramount. And I think that applies to crypto as well. Last year was a year with a lot of headwinds, some self-inflicted wounds, but as we rebuild trust within the ecosystem with major players, I think the future is extremely bright. 2024 is going to be marked by a reversion to core first principles. Recognizing that compliance in crypto, like all financial services, is very important to build trust and scale into the opportunity crypto represents. We have to have a compliance-first mentality. Now, that was Brad from Davos a couple of years ago, and here's the significant part. Everything he articulated he wanted to emerge from Davos has already materialized. So where does that guide us next? Bigger developments, more substantial initiatives, like the New York Stock Exchange getting tokenized, like additional ETFs, like institutional capital finally flowing in at meaningful scale. The ball is in Coinbase's court. So how do we get there? It all begins right here. The ball is in Coinbase's court as the crypto market structure bill hits pause. And yes, they're essentially attributing the pause to Coinbase. If the holdup concerns yield, fine, leave it blank. Revisit it later. Because I can tell you right now, institutions do not care about yield yet. They care about clarity. They are waiting on clarity so they can legally deploy capital. You can sort out yield next week, next month, 6 months from now. You can debate who can offer yield, how much yield, whether DeFi yield is permitted. All of that can be addressed later. But clarity, that needs to happen now. There is far more in this bill than just yield provisions, and allowing one issue to stall the entire framework makes no sense. Move forward, keep progressing. Then the banks can convene. The major banking establishment can sit down. Brian Armstrong can show up. Brad Garlinghouse can show up. Charles Hoskinson, wherever he's positioned, probably in the mountains of Wyoming, he can show up too. And then you work out what's fair, what's sustainable, and how this market advances long term. How the Clarity Act opens institutional floodgates. So how does the Clarity Act open the floodgates for institutions? It's actually quite straightforward. Here are the key institutional catalysts. First, banks can conduct digital commodity activities under the amended Bank Holding Company Act. Second, the repeal of SAB 121 in January 2025 allows banks to custody crypto assets without treating them as liabilities on their balance sheets. That's enormous. Third, The OCC has conditionally approved national trust bank charters for firms like BitGo, Fidelity, Paxos, and don't forget Ripple, which directly supports ETF infrastructure. Fourth, the SEC has already made progress independent of the Clarity Act. But here's the real unlock. If the Clarity Act passes and tokens are classified as commodities, and we already have a list of 8, instead of securities, those tokens are exempt from SEC securities regulations. And what does that mean? It becomes dramatically easier for ETF issuers to launch products. That's the key, folks. Connecting all the dots. Because I'm telling you right now, between the New York Stock Exchange announcements, the 3 blockchain candidates, the BlackRock timeline predictions, and where XRP ultimately positions itself, this is aligning exactly as anticipated. The private regulatory meetings, the CFTC pilot program, the TJM partnership, the tokenization infrastructure being built, none of this is happening in isolation. These are coordinated movements by institutions and regulators preparing for a fundamental transformation in how financial markets operate. When BlackRock gets involved, when the NYSE announces tokenization plans, when the CFTC creates sandboxes with specific crypto companies, when regulated brokers partner with blockchain platforms, you're watching the infrastructure for the next generation of finance being assembled in real time. The question isn't whether this transformation is coming. The question is whether you recognize what's being built before it becomes obvious to everyone else. Recent developments in early 2026 continue to reinforce this trajectory. Regulatory clarity discussions are advancing, institutional infrastructure is expanding, and the major players are positioning themselves for what comes next. The bigger picture retail investors often focus on daily price movements and short-term volatility. Institutions focus on infrastructure, regulatory frameworks, and long-term positioning. Right now, we're witnessing institutions position themselves for a market structure that doesn't fully exist yet, but will. When regulators call CEOs into closed-door meetings, when the CFTC creates pilot programs with specific participants, when traditional exchanges announce tokenization initiatives, when major asset managers launch crypto products, these aren't random events. They're coordinated preparation. The shakeouts, the manipulation, the price suppression, that's not about destroying crypto. It's about accumulating it at favorable prices before the infrastructure goes live and institutional capital deploys at scale. Understanding this distinction is critical. The narrative isn't crypto versus institutions. The narrative is institutions building the rails to bring crypto into traditional finance. XRP's positioning within this framework, with regulatory clarity progress, institutional partnerships, payment infrastructure development, and ETF accumulation, suggests it's being prepared for a specific role within this emerging system. Final thoughts. This is not financial advice, but it is a framework for understanding what's happening beyond the headlines and price charts. The closed-door meetings, the regulatory sandboxes, the institutional partnerships, the exchange tokenization plans, these are the signals that matter. Price follows infrastructure. Capital follows clarity. We're not watching crypto try to replace traditional finance. We're watching traditional finance absorb crypto on its own terms, with its own infrastructure, under its own regulatory frameworks. The institutions moving now aren't speculating. They're positioning. And when that positioning becomes deployment, the market structure will look fundamentally different than it does today. The question is whether you're paying attention to the right signals while everyone else is distracted by the noise.